Your John, AG here. February 7th, 2026. Silver sitting at $76, gold hovering around $4,900. And if you're confused about whether this is a crash or a bounce, you're asking exactly the right question. Because what I'm about to show you is that it's both. And understanding that paradox is the difference between making money and losing it. Silver hit $121 on January 29th. 8 days later, it touched $64. That's a 47% collapse. The worst intraday swing since 1980. Gold peaked at $5,608, crashed to $4,404, and now it's fighting to hold $4,900. We're watching volatility that hasn't existed in precious metals for over 4 decades. And here's what nobody's telling you. This isn't over. Not even close. Looking at the numbers, about 3 out of 4 of you watching aren't subscribed. If this is cutting through the confusion and helping you see what's actually happening in these markets, hit subscribe. That's how I know who's serious. If you're getting value here, drop your John AG in the comments. It helps my team understand what resonates. If it's not your thing, no problem. I don't chase vanity metrics. I'm here for the people who want unbiased truth, not the polished nonsense you get from mainstream financial media. Now let me show you exactly what just happened and what's coming next. The crash that shook everything January 30th, 2026, the day the precious metals market imploded. Silver opened around $110. By afternoon, it had cratered to $78, a 31% loss in one session, the largest single-day decline in silver since March 1980 when the Hunt brothers tried to corner the market and spectacularly failed. Gold wasn't spared. It dropped 11% from record highs near $5,600 down to $4,745. Together, approximately $15 trillion was erased from precious metals markets in 48 hours. $15 trillion. That's half the GDP of the United States. Gone. The mainstream story? Simple. Kevin Warsh nominated as next Federal Reserve Chair. Markets panic because Warsh is hawkish. Higher interest rates mean stronger dollar. Stronger dollar crushes commodities. End of story. Except the crash started 3 hours before the Warsh announcement. I need you to understand that. The price was already collapsing before the news that supposedly caused it hit the wires. This wasn't reaction. This was execution. The mechanics behind the massacre. Here's what actually triggered the liquidation cascade, and I have the receipts. CME Group raised margin requirements on January 30th. They jacked silver margins from 11% to 15% for standard positions, and from 12.1% to 16.5% for heightened risk accounts. Gold margins went from 6% to 8%, heightened risk from 6.6% to 8.8%. Shanghai Gold Exchange did the exact same thing. Margins raised to 11% for speculative positions. Daily position limits slashed to 800 lots. 16 clients barred from opening new positions or withdrawing funds. 2 major exchanges, coordinated margin hikes. Same-day silver hits all-time highs. This created a forced liquidation machine. Traders profitable yesterday suddenly faced massive margin calls. Can't post more capital? The system liquidates you automatically. Your selling pushes prices lower. Lower prices trigger more margin calls on other traders, more forced selling, death spiral. This wasn't retail panic, this was systematic destruction through margin mechanics. And while everyone was getting annihilated, one entity was positioned perfectly at the bottom. JP Morgan Securities. COMEX data shows they closed 633 silver short contracts at exactly $78.29, the precise low. Then the recovery began. 633 contracts equals 3.17 million ounces, roughly $250 million in profit. They timed the bottom to the dollar. Not luck, precision. The bounce that surprised everyone. But here's where it gets interesting. Markets don't recover this fast from legitimate crashes. Silver dropped to $64 on Friday, February 6th. By mid-morning, it had bounced to $76, a 19% recovery in hours, volatility levels not seen since 1980. The price whipsawed so violently that multiple trading desks couldn't even quote spreads. Gold fell to $4,404 Monday morning, recovered to $5,070 by Wednesday, currently holding $4,900. That's a $666 bounce in 72 hours. This tells you something critical. The selling wasn't about fundamentals. It was about leverage. Look at what happened to physical demand during the crash. SD Bullion, one of the largest precious metals dealers in the U.S., reported their highest transaction day in company history on January 30th. Not just busy, the busiest day ever. They processed 2.5 times more transactions than their previous all-time record from the Silicon Valley Bank collapse in 2023. The paper price crashed 31%. Physical demand exploded 250%. Dealers across the globe reported the same thing: zero inventory. Wait times surging from 2 to 3 weeks to 8 to 10 weeks. Perth Mint temporarily shut down new sales just to catch up on existing orders. Switzerland, the refining capital of the world, reported zero stock of silver available for delivery. While the paper market said silver was worth $64, the physical market said you can't buy it at any price. The Shanghai premium that proves everything, and then there's China. The smoking gun that proves this entire move was paper manipulation disconnected from physical reality. On February 2nd, while COMEX silver was trading at $80, Shanghai spot silver was trading at $111. That's a $31 premium, nearly 40% higher than Western paper prices. When you add China's 13% value-added tax, the replacement cost for silver inside China was $36 above Western prices, $36 per ounce. That's not a premium, that's a chasm. In a functioning market, arbitrage traders close that gap immediately. Buy cheap in New York, ship to Shanghai, sell high. Lock in $34 per ounce risk-free profit. Shipping costs, maybe $2 per ounce. Net profit, $32. Free money. But the gap isn't closing. Why? Because on January 1st, 2026, China officially reclassified silver as a strategic resource. Only 44 companies in the entire country received authorization to export silver for 2026 and 2027. That covers 121 million ounces annually, representing 60 to 70% of all refined silver traded globally. China controls global refined silver supply, and they just locked the door. Metal goes into China. It doesn't come back out, ever. Every ounce flowing from COMEX vaults to Shanghai is leaving the Western financial system permanently, and the $36 premium is the market screaming that the West is running out of deliverable metal. Today's price action, where we stand right now. As of February 7th, silver is trading around $76. Gold is holding just under $5,000. Silver is down 37% from its January 29th peak of $121. But it's still up 135% from 1 year ago, when it was $32.30. Gold is down from $5,608, but still up 68% year over year. The mainstream narrative says the bubble popped. Speculation is over. Time to move on. But the fundamentals haven't changed, not even slightly. The United States Geological Survey designated silver as a critical mineral in November 2025, for the first time in history. Same legal category as uranium. Industrial demand is accelerating. Solar panels consume nearly 30% of total global silver demand. Every panel uses about 20 grams. Electric vehicles use 25 to 50 grams each. AI data centers need silver for semiconductors and electrical connections. The silver market has run a supply deficit for 6 consecutive years. Annual mine production is 800 to 850 million ounces. Annual demand exceeds 1 billion ounces. That 150 to 200 million ounce annual deficit is being made up by above-ground stocks, warehouse inventories, ETF holdings. But those inventories are disappearing. COMEX registered silver inventories are down 70% since 2020. The LBMA in London has lost roughly 40%. Shanghai inventories are at their lowest level since 2015. The physical metal is being consumed, destroyed, used up in solar panels, data centers, and missile guidance systems. It's never coming back. The two camps, stackers versus traders. Let me address the two completely different groups watching this right now. First, the long-term stackers. That's roughly 70% of this channel. You've been accumulating for years, maybe decades. You have a plan. You understand fundamentals. Your time frame isn't daily or hourly. It's monthly, yearly. You see a 37% crash and you're not panicking. You see opportunity. You're probably more interested in the fact that despite this volatility, silver is still up 135% on the year. You see the Shanghai premium at $36. You see the physical market completely disconnected from paper. You're calm. You see the bigger picture. Then there are the short-term traders, those without discipline or a plan, those who thought markets only go up. For you, this has been a nightmare. A 47% intraday swing with high leverage is a liquidation catastrophe. If you were over-leveraged on the wrong side or trading without stops, this move destroyed you. Forced liquidations don't care about your thesis. They don't care about fundamentals. They care about math. I've been warning about this, the dangers of leverage, the risks of short-term trading without a solid plan. If you've been following from the start, you knew this was possible. We discussed it. And for new people here, let me be absolutely clear. I don't sell signals. I don't sell mentorship. I don't sell courses. The real community here knows this. My handle is your John AG on both YouTube and Twitter. If you're not following there, you're missing real-time analysis. Be aware there are fake accounts repackaging my content, giving you fake signals and false information. I'm not responsible for that. Verify the handle. Follow the real account. I don't give you one-sided hype. No Moonboy predictions. No fear porn. I give you unbiased analysis. And I've always told you to use your own brain. Know which camp you're in, long-term stacker or short-term trader, and act accordingly. The bearish case you need to hear. Let me give you the bearish argument because intellectual honesty matters. This crash was absolutely brutal. Silver fell 47% from peak to trough in 8 days. That's not a correction. That's a collapse. UBS says silver's volatility is approaching levels not seen since 1980. They're forecasting a return to $100 by next month, then a pullback to $85 by year-end. Goldman Sachs analysts Lena Thomas and Don Striven are cautious on silver, citing the persistent London liquidity squeeze, adding extreme price behavior on top of structural volatility. They're advising volatility-averse clients to remain cautious. Bank of America ranked silver number 1 for bubble-like dynamics, ahead of every stock, every crypto, every commodity on Earth. JP Morgan's strategists have called it a speculative mania and are targeting $50 silver. The technical damage is severe. If you were trading on leverage, you got liquidated. If you had tight stops, you got stopped out at the worst possible prices. If you were overpositioned, you're massively underwater. CME raised margins after the crash. That's pouring salt in the wound. If you survived the initial drop and held futures positions, now you need to post even more capital or get forced out. That creates follow-on selling pressure, more liquidations, more volatility. The first U.S. bank failure of 2026 just happened. Metropolitan Capital Bank and Trust closed by Illinois regulators. Assets $261 million. If more banks fail, if liquidity continues tightening, if credit conditions worsen, we could see more forced selling across all asset classes. In the initial stage of a crisis, margin calls forced selling of liquid assets first, regardless of fundamentals. The paper market can stay irrational longer than most traders can stay solvent. We just saw $15 trillion erased in 2 days. There's no guarantee it stops here. We could see more selling, more liquidations, more panic. If you're trading this on margin, this environment is a meat grinder. That's the bearish case, and it's real. Why the bullish case is still overwhelming. But here's why the bearish case for paper doesn't change the bullish case for physical. JP Morgan closed 633 short contracts at the exact bottom. That's not luck. That's COMEX data. They timed it perfectly. At $78.29, then the price recovered. That's not speculation. That's orchestration. On January 30th, approximately 1.8 billion ounces of paper silver were traded on COMEX. Annual global mine supply is 800 to 850 million ounces. They traded more than double annual production in 1 day, while physical buyers wait 8 to 16 weeks for delivery, while Shanghai premiums sit at $36, while COMEX delivery notices totaled 2,955 contracts in the first 4 days of February, a traditionally non-delivery month where volume should be near zero. The paper market and the physical market are completely disconnected. And the proof that this was orchestrated is right there. JP Morgan closed shorts at the exact bottom. The moment they covered, recovery began. Metropolitan Capital Bank failed. When banks fail, liquidity concerns spread. Trust erodes. The initial move is always liquidation. Margin calls forced selling of everything, including safe haven assets. But then comes phase 2, the realization that the system is fragile, that banks are failing, that trust is breaking. And that's when the safe haven bid returns. That's when physical premiums explode. We're in the transition between phase 1 and phase 2 right now. Goldman Sachs has a $5,400 price target on gold by end of 2026. Bank of America is even more bullish at $6,000. And here's what nobody's connecting. If gold goes to $6,000 and the gold to silver ratio compresses from 65 to 1 to the historical average of 50 to 1, silver goes to $120. If it compresses to 40 to 1, silver goes to $150. The structural drivers haven't weakened. They've strengthened. Silver is in a 6-year deficit. China restricted exports. Industrial demand from solar, AI infrastructure, and electric vehicles is accelerating every quarter. COMEX inventories lost 70%. LBMA, London Holdings, down 40%. Silver lease rates exploded from 0.5% to 8% and haven't come back down. That's not a market that just had its bubble pop. That's a market where physical metal is genuinely running out while the paper market pretends everything's fine. The unresolved tension. Here's the question everyone's asking. Is this crash over, or is there another leg down? We just saw the biggest daily silver loss on record. But JP Morgan's COMEX positioning proves it was planned. The shorts are closed, the weak hands are flushed. Does a second wave of selling come, or does physical reality reassert itself now? With the first bank failure of 2026 confirmed, how many more are coming? When does the flight to safety phase begin? $15 trillion erased, biggest daily loss ever. First bank failure, 1.8 billion ounces of paper dumped in one day. And JP Morgan closed 633 shorts at the exact bottom. This is the proof. This is the smoking gun. The crash was planned, timed, and executed with precision. And the physical market is telling you the paper system is on borrowed time. 3 key takeaways. Number 1, JP Morgan closed 633 silver short contracts at the exact bottom of the crash. This is documented in the COMEX report dated January 30th. Not near the bottom. At the bottom. Then the price recovered. This isn't coincidence. This is proof the crash was planned. Number 2, 1.8 billion ounces of paper silver traded on January 30th. Annual global mine supply is 800 to 850 million ounces. They traded more than double annual production in one day, while physical buyers wait 8 to 16 weeks, while Shanghai premiums sit at $36, while delivery notices total 2,955 contracts in a non-delivery month. The paper market is fiction. The physical market is screaming deficit. Number 3, first U.S. bank failure of 2026. Metropolitan Capital Bank and trust closed. Banks failing. Liquidity tightening. Trust cracking. Initial reaction is risk-off liquidation, but phase 2 is flight to safety. We're in the transition. CME hiking margins after the crash adds pressure short-term, but it confirms the system is stressed and fragile. Where this leaves you. Do your own due diligence. Understand the risks. If you're trading on leverage, this volatility is a liquidation machine. 47% intraday swings wipe out over-leveraged positions instantly. But if you understand what's actually happening, JP Morgan timing the bottom perfectly, paper trading double annual production in a day, physical premiums holding at 45%, then you know this crash is not about fundamentals. It's about desperation. It's about one final flush before the paper system breaks. Silver at $76, gold just under $5,000. The crash is real. The bounce is real. And the disconnect between paper and physical is wider than it's ever been. This isn't over. The question isn't whether precious metals go higher. The question is whether you're positioned when the physical reality finally overwhelms the paper manipulation. Invest with logic, not hype. Your John A. G. out.